Crikey, Ollie. I was just reading this fascinating piece, right, about the billionaire's broken clock. And it's quite the head scratcher, really. This idea that being right is like a terrible strategy in investing. Sounds a bit mad, doesn't it?
Ah, James, that's a ripper, isn't it? The billionaire's broken clock. I love that concept. It's totally counterintuitive, I know, but it makes so much sense when you dig into it, mate. It's not about actually being wrong all the time, obviously, but more about building systems that can profit even when your predictions aren't spot on. Acknowledging you're probably going to be imperfect.
Right, exactly. Because my first thought was, hang on, I'm trying to be right as much as possible. But the analogy, the broken clock, it's right twice a day. So are we talking about just like waiting it out, patiently sitting on a bad decision until it eventually turns good? That seems a bit risky, doesn't it?
Well, it's not quite that, mate. It's about non-consensus thinking, really. Most investors, they're all chasing the same signals, right? Trying to be the perfect, accurate clock. But if everyone's doing the same thing, you end up with a closet indexing, just following the crowd. The broken clock approach says, nah, you make your best analysis based on differentiated research, and then you patiently wait for the market to catch up to your unique view. You're not constantly fiddling with the hands. It's a big mindset, I reckon.
So it's about having conviction in your own analysis, even if everyone else is heading in another direction. That takes some serious guts, I imagine.
Absolutely, James. Massive guts. Because the challenge often comes when you're, ahead of the curve. You look wrong for a while, and that's bloody hard to deal with, right? Socially, financially, people start questioning you. But the real genius of this strategy is learning to profit from being wrong, or at least building resilience so being wrong doesn't sink you. Profiting from being wrong. That sounds like something out of a magician's hat, Ollie. How on earth does how does one actually do that? I'm picturing making a bad investment and then magically it turns good because you wished hard enough.
Not magic, mate. It's more about strategic risk management. One way is what they call investing like you're wrong. You build in strategies to eliminate risk even when a position starts to move favorably. Take the free ride strategy, for instance. Say you invest in something, it doubles, right? You then sell enough shares to get your initial capital back. So now the remaining shares are effectively a free ride. They can go up, they can go down, but your original money's safe. You've profited from the upside, but cushioned yourself against being wrong later.
Oh, I see. So it's not about the initial prediction being right or wrong, but about how you manage the position as it evolves. You're building protective layers. That's clever. That's really clever, actually. It takes the sting out of being early, I suppose. Precisely, mate. And that segues beautifully into another key aspect, the value of being early. A lot of people say being too early is the same as being wrong, especially for short-term stuff. And in day trading, maybe. But for long-term growth investing, it's a completely different ballgame.
Yeah, I've heard that phrase, too early is wrong. It makes you hesitant, doesn't it? You wait for all the signals to align, for the market to confirm your suspicions, but then you've probably missed a big chunk of the initial move, haven't you?
Exactly. That's it. Waiting for confirmatory signals often means you're late to the party. Markets rebound super quickly sometimes, and if you're standing on the sidelines waiting for everything to look rosy again, you miss out on those significant recoveries. Warren Buffett, bless him, he's always banging on about patience. He totally emphasizes that the market rewards those who can sit on their hands, not those who are constantly trying to time the bottom or the top. Emotional discipline, that's what he preaches.
So even if you buy something and it goes down a bit or just stagnates for a while, as long as your fundamental analysis is sound and you're in it for the long haul, that initial early entry can still massively pay off due to compounding. That's quite a shift from the typical investor mindset, which is always looking for immediate validation, isn't it?
It absolutely is, James. It's a huge shift, and it's how true wealth is built, I reckon. So, when you bring it all together, James, The broken clock, non-consensus thinking, the value of being early. It paints a picture of a robust, patient, and truly contrarian investment philosophy. It's really about accepting that perfect predictions are, well, a myth. We're never going to nail it every single time.
Right. So instead of striving for this impossible perfection, you're building a system that can absorb the inevitable errors, yeah? It's almost like having a really sturdy ship that can handle a few storms, rather than trying to predict every single ripple on the ocean. That's a much more sustainable way to think about it, I suppose.
Spot on, mate. It's exactly that. You're not trying to avoid storms entirely, because you can't. You're making sure your vessel's got a strong hull and a good crew to navigate through them. This allows you to capitalize on opportunities that arise precisely because they're non-consensus, or during market downturns when everyone else is like panicking and selling. Those are often the absolute best times to invest, aren't they? When the blood's in the streets, as they say.
That makes a lot of sense, Oliver. It's like the market's inefficiencies create these windows for the patient, contrarian investor. You're not reacting to the daily news cycle, you're looking beyond it. It sounds incredibly freeing, actually, not having to worry about being perfectly right all the time. But how do ordinary folk, apply this without a billionaire's war chest, you know?
That's the million-dollar question, James. And it's totally applicable to us, too. You don't need a billionaire's war chest to adopt the mindset. First point, focus on understanding the value of what you're investing in, not just its price fluctuations. Do your own research, really dig in, even if your findings go against the popular narrative.
So it's about conviction in your fundamental analysis, like we talked about earlier, not just following the latest hot tip from a mate down the pub. And that means, I suppose, not being afraid to look a bit daft for a bit if your investment takes time to prove itself.
Precisely. Second point, build in those safety nets. Think about strategies like the free ride, or just generally diversifying appropriately so no single wrong prediction takes you out. It's about managing your downside rather than just chasing limitless upside. And finally, cultivate emotional discipline. This is probably the hardest bit, mate. Don't let fear or greed push you into impulsive decisions. The market will test your patience.
So basically, be patient, do your homework, manage your risks, and try not to get swept up in the crowd's hysteria. It sounds simple when you say it like that, but I imagine it's incredibly hard in practice, especially when everything's like flashing red. But it's a powerful framework, Oliver. Really, really insightful.
It is, mate. It absolutely is. And it's how you come out ahead in the long run, I reckon.
So, James, we've peeled back the layers today. If this resonated, if for the first time the path to real wealth feels clear, then do 3 things for me right now. First, subscribe to this podcast. We go deeper weekly, and you don't want to miss it. Second, take a screenshot of this episode. Post it on Instagram or LinkedIn stories and tag me. Tell me what you feel. I'll reply to give feedback and advice.
That direct engagement is invaluable, Oliver. A personal touch that can really help solidify these concepts.
Exactly, mate. And third, share this episode with one person. That friend you brainstorm with, that colleague meant for more. Because the best way to solidify your own knowledge is to share it.
Superb, Oliver. These are critical steps, not just to learn, but to truly internalize and apply these powerful frameworks.
Precisely. It's how you turn insight into action and truly build lasting wealth.